history, the Rothschilds, the greatest banking dynasty that ever lived. Still around today, still the wealthiest family. And you can learn their secrets to build your dynasty, your riches, just like the Rothschilds. The world's greatest dynasty that ever lived. The Rothschilds started out in the slums of Germany. Mayer Rothschild were not as wealthy as the Vanderbilt or Rockefeller, yet today is the greatest dynasty in the history of the world. Mayer Rothschild and his 5 sons span the globe, running central banks all over the world. You can learn to implement the bankers' rules that were created and used by Mayer Rothschild. You may have noticed all the banks are owned by individuals or families. This is a clue that anyone can do this. But I'm not talking about getting a banking charter or buying a building. But I'm talking about using the same rules that make the banker rich. The banker's rules guide and help keep us from the human error that is depleting the banker's funds. I bet you have a whole lot of questions like, how do I get started? Where does the money come from? Do I need my own money? And a whole lot more. Let's dig in and find out what we can do to be just like the Rothschilds. Lesson 1: Building your bank. Alright, so lesson 1 is going to be on building your own bank. You might think, well, how do I even start building my own bank? Well, we're not going to get a charter. We're not getting a banking license. No, nothing like that. This will be a family bank. A privatized bank. It's a banking concept. So with that in mind, we're not talking about a savings account, but you can keep your money in a savings account. You can keep it in a tin can, you can keep it in a life insurance policy. There are many different vehicles you can keep your money in. But the banking concept is what I'm talking about. Building your own bank to build your own wealth. So how can I start this, and with what money? Well, you need your own money that can be set aside. Extra money. If you don't have extra money to start with, you're not going to be able to do this. But if you can save at least $200 a month, this might sound big for some people, but easy for others. If you can save $200 a month over time, you can build up your money. Then what you'll do with this savings, for example, say you have a credit card of $2,000 you are paying on. What you'll do is go pay that off with the money from your bank, aka your savings that you had set aside. Pay that credit card off. But then you start making payments to yourself, the same as if you were making payments to that bank or credit card, at the same interest rate. Now, me personally, I always do 20%. I always up it, because I don't want to use my money. So I always charge myself 20% interest. Higher interest rate for using my bank. But I recommend paying the same payment that you are already paying. In this way, it's like nothing's changed. The returns over time will start building up wealth. You can borrow against the money you have in the bank, but you must pay back your bank plus the interest. You need to remember the rules, which we'll get into in a later chapter. Building your bank will take time and a lot of discipline. You can't spend the money you have in the bank without paying it back with interest. Otherwise, that's the demise of your bank. It's no longer there, so you have to get a banking mindset. It takes a while to build a banking mindset, but for others, like myself, it takes no time at all. I had started by building up $7,000. I paid off my car loan. Now my bank has bought the car. And I now owe my bank plus the interest, the same as I was paying. In a later lesson, we'll get into assets and liabilities, but I turned my car from a liability, which it still is a liability because I'm still paying on it. But I own the bank that is receiving my payments. So it also became an asset to me. So as I'm paying down the asset of my new car, or new car payment, I should say. It's the same car, but my bank bought it. As I'm paying back my bank, I can take loans off that money. This creates velocity. You may also lend that money out to others, which we'll talk about in later lessons. We'll get further into those details. But I want you to have the basics on building your own bank. I'll explain the rules that you need to follow in a later lesson. You can borrow money from other people, but you need to look at keeping the lending laws. Each one is different in each state. These lessons are designed to help even the average person, or maybe a more impoverished person. Anybody can use these principles to set aside the money to build up their bank. I want to make this clear that you know that any money that you lend to yourself is your own and no one else's. You don't want to borrow from others to support yourself. You want it to come from your personal bank or money outside your bank. You do not want to lend yourself other people's money. You can get into some big trouble if you're still working, and you lose your job and now you owe these other people money. You don't want to get into those issues. With that said, the first thing with this lesson and getting into building your own bank is setting aside that money, building it up so that you can pay off your credit card, car payment, or student loans. What have you? As you pay off one lender, you'll be buying up those loans, you'll start building up and keep building up that cash. You can take that money that you're paying and add it to your payment to speed up the process. Or as I like to do, keep the money aside in my bank in case of emergency. Or when a payoff comes up, I'll match the payoff. Then I'll start paying my bank, and then that loan that I was paying out is still a liability. I still owe that money. I still have to pay for it. But now I'm paying it back to me or my bank. So if you look at, let's say for instance, you have a certain interest rate, you buy a camper for $17,000 brand new. Your interest rate is $4,000 over the life of the loan. Say it's 10 years, you'll end up owing, in the 10 years, say $21,000. You keep making those payments to the bank entity. Once you can match and pay off that lender, start making the payments to your bank. I love to pay off lenders. Not only is the loan my liability, but it becomes an asset for me. Back to the loan, I take part of that $4,000 that I'd be paying out in interest. Now the money gets converted back into my bank. My personal bank, or your personal bank when you do this. So that's the gist of how this works. We'll get into more details in the second lesson of liabilities to assets. Hopefully this will give you enough to get started. These lesson plans are made to help you build your bank, get established, and to get the mindset established. I have more lessons I'll teach you on how to go further into lending money out, which we'll cover in these lessons, but not as in depth. You'll learn and understand how to buy real estate or lend money against real estate to build more wealth. So with that in mind, we'll get into Chapter 2, Lesson 2. Lesson 2, Liabilities to Assets. Now if you're not clear on liabilities take money out of your pocket. Say you have a car payment, house payment. Your money is flowing out. If you have assets, they put money into your pocket. You still have stuff like houses and cars. But you now own the notes on these and they pay you. Now we briefly touched on assets and liabilities in the first chapter and talked about how my bank bought my car. And I took the money plus interest I was already paying to another party and put it back onto my bank towards the car. So now I became the entity that was receiving these payments. Even though my car payment is a liability, it became an asset. As I was driving my car one day, I thought, this is great. I'm driving around knowing that I had an asset that was making me money. It was a nice feeling. Personally, you can build up your assets the same way. By building up the finances in your bank, you'll be able to finance the liabilities you are already paying. In return, you'll be paying back to yourself, or I should say your bank, the money plus interest that you would have to pay to the other lenders. Some people say it's only 10, 12% or more if you are late. You may not really realize how many loans you really have out there. You're probably paying out, like most people, 35%. Much of what you make is going right back out to lenders. Around 25% is going into interest alone. Now, you're paying out of your pocket each month, each year, plus there's taxes. We can't avoid paying taxes. So between liabilities and taxes, you're paying out quite a chunk of money. Right out of your check before you get any of it. You pay the rent or mortgage, utilities, groceries, credit card companies, and many others. But you're not paying yourself. We will go deeper into liabilities and assets through this chapter. I want to go into the fact that you can lend out your money to others against their collateral using a promissory note with a security instrument. With that promissory note, which is a promise to pay you a set amount plus set interest rate over the life of the loan. We'll get more into promissory notes and lending your money out to others in a later lesson. Right now I want to concentrate on building your wealth. Building up your money. Here are examples to give you a clear understanding. I had made several loans to myself. The first one was to repair my driveway. I lent myself $400. I paid myself back with interest the sum of $100. So I paid back $500. A friend told me, I need just $500 more to rent an apartment. I loaned the $500 out at 20% interest in a promissory note. I did not ask for collateral. Not usually such a good idea. Lending without collateral is a lot more risky. He did pay me back in 6 months. Though he had up to a year. I took that $600 and set it aside in my personal bank. Until I could lead it out to another friend. Another friend needed to borrow $600. Well, here we go. I have $600 to lend her. She paid me back the money plus interest. I also had helped a family member with a $3,000 loan. They paid me back quite a bit so far, but they're still paying on that loan, giving my bank cash flow each month. Some of that went to going on vacation. I borrowed the money just like anyone else. But I'm paying those loans back to my own bank. In return, the credit line I lent to myself becomes an asset. And still a liability. A liability to an asset. I own the entity that is receiving my payments. Therefore, I'm building my wealth. And with that, that is liabilities to assets in a nutshell. The next lesson will be the banker's rules. We'll get more in depth with the rules that you need to keep to govern your finances. As we have the human factor to deal with, we want to spend this money and use it but not pay it back. That's the problem of being the banker, you have the power not to pay yourself back. And that can get you in a lot of trouble. With liabilities to assets, we showed you how to build your wealth. For example, at one point I was working 14-hour days 5 days a week. That helped me build up quite a bit of wealth, as I pay into my bank just like the example of the camper in the first lesson. I have a $17,000 camper payment plus interest. It takes a while to build that amount up. I also loaned out some money, so I have that money coming in as payments. Call that velocity of money, and that will change things, because you end up making even more money. Well, you can pay down your assets or liabilities. Like I said, I like to keep money back in my bank so that I have it just in case of emergencies. Or if I need to buy something or have money to loan out to others. I like to keep that money flowing. It's not just sitting there in someone else's account and not making any money. I like to keep my money working for me, to keep my bank prosperous so I can help others. And that's the nice thing, that you can help your friends but make sure they're trustworthy, that they will pay you back. You should get collateral from others. You may request in order to get the loan they need to fill out a security instrument also known as a collateral security sheet. Have them sign a promissory note. You can agree on what you'll get in return if they do not pay you. It's good to keep yourself secure that way. Banking is about security in finances. It's not about investing. You're not investing. You're not taking risks. Keep your eyes on the risk. Try to eliminate them as much as possible. Focus on the downside. Let the upside take care of itself. Because you'll have a lot less risk doing it this way. Well, like I said, I have in the beginning I lent out that money unsecured, which is very much not recommended. But if you do trust the people in the family and you know they'll pay you back, you may want to help them. There is nothing wrong with doing that. You can help buy someone a car, a nephew or your daughter. You should follow your underwriting criteria. This is the criteria by which you make to govern your lending. You can use these concepts to help build up your bank as you pay for liabilities. It's like loaning you kids money for college. Just like any other loan, they will pay back with interest. Someday they will inherit the wealth account. In this way you are building your wealth like the Rothschild. They pay you back the loans instead of the government. It's a wonderful banking concept, to be able to have that power and security that you can take and build your wealth. We'll get into BOLI's bank-owned life insurance policies, which you can own as well. Life insurance can be the best place to park your money when it is not lent out. Use the same concept, but you will borrow the insurance company money, not yours. Keep your money moving to build interest. Keep loaning out money to build more interest. There will be more to that in like lessons, I just want to let you know that. Hopefully that will be an itch in your ears. I want you to learn more about banking because that is where this really can shine. Hypothecation is when an asset is pledged as collateral to secure a loan. The owner of the asset, like a note you own, does not give up title ownership rights, such as income generated by the asset. Like a rental property, for example, may be hypothecated as collateral against a mortgage issued by a bank. Well, we'll get into that in later chapters because that is where you'll be lending money out and you will learn how to ramp up your lending. By lending out the money, you'll come to learn how to build up your finances even quicker. We'll finish up where for now. So let's get into the next lesson, the banker's rules. Lesson 3, Banker's Rules. In this lesson we're going to show how banking is so powerful. The rules that govern us as bankers are simple, but if not kept can be disastrous. Now let's begin. Banking is about financing and safety. We finance the risks of others by playing it safe. We tie up as much collateral as possible, around 150%. You may think that is asking a lot, but you need to absorb the risk. I make loans at 20% and people say that's like a credit card as they write down the collateral and sign my promissory note. Remember, you make the rules that others have to follow. This is some of the power of being a banker. We do not take part in others' risks. We do not invest. We finance. Rule 1, Finance. Understanding of private lending. Pertinent laws and regulations. These laws are different in each state, therefore I will not be going over this. but I list it so that you are able to look into the laws and regulations in your area. If you are only building up your own bank and not lending to others, this is not necessary. Rule 2. Safety. Shift the risks. Set up LLC. Build your underwriting criteria, your policies. Safety is about shifting as much risk toward the borrower. You don't want to get stuck with someone not paying you. If and when this happens, you need to have as much collateral tied up as possible. Around 150%. This keeps you in the safest position possible. Now, if you are just lending to yourself, you don't need the collateral, but you do need to pay back your bank. Keep in mind that the bank is like a separate entity. If you plan on lending to others, this is where an LLC may work in that it is legally a different entity. This will also provide protection against lawsuits and protect your assets. Your underwriting criteria and policies. Though it might sound complicated, underwriting simply means that your lender verifies their income, assets, debts, and property details in order to issue final approval. Rule 3. Be trustworthy, be disciplined, have integrity, be good with money, find borrowers, structure great deals for safety and profit. That is being trustworthy in a nutshell. Rule 4. Bankers' habits. People do not save money. Not like a banker. As a result, someone else must provide the capital necessary to maintain their way of life. That comes at a very high cost to their own habits. As a banker, with access to cash, you will dictate the rules and the terms of these loans. All sorts of good opportunities will appear for you to negotiate favorable loans. So overcome the temptation to buy the toys and items others want to buy. Just live within your means and let your money work for you. In time, you'll be able to buy them and make money at the same time. As the banker, you'll dictate the rules and the terms by which the borrowers buying these toys have to follow. Remember, cash flow is everything. Access to capital is king, not cash. Control is everything to keep your bank operating. The biggest challenge to having a successful banking system is being human, so we as bankers need to follow the banker's rule. There is nothing worse than getting trapped in our own comfort zone. Lesson 4. The banker's language. Learning the language of bankers is the knowledge of the banking terms. This lesson goes over the terms you should get familiar with. ABS. Asset-backed security. See asset-backed security. The name for a convention used to express the rate of prepayments for an asset-backed security. ABS expresses principal prepayments as a percentage of the original number of loans or contracts in the pool of securitized loans that created the security. ABS is always expressed as a monthly rate. Abstract of title. A written report summarizing the history of title transactions and conditions of title that affect a given piece of land covering the period from the present back to a date in the past. A comprehensive, but cumbersome, and somewhat obsolete, method of verifying the ownership and encumbrances of a parcel, or parcels, of real estate. Accelerated depreciation. A group of methods for achieving periodic reductions in the book value of fixed assets that make larger reductions in the early periods and progressively smaller reductions in later periods. The offsetting entry is the depreciation expense. Acceleration. Making demand for payment in full for a debt that has not yet matured. Usually a remedy provided in a loan document for the lender to use in the event of default by the borrower. Acceleration clause. A provision in a loan document stating that the entire amount of unpaid indebtedness owed to the lender may become immediately due and payable if the borrower defaults. Accessions. Goods that are physically united with other goods in such a manner that the identity of the original goods is not lost. An example is a new motor in a piece of equipment. Account analysis. An analysis performed to determine the profitability of each demand account to the bank. The analysis may also be used to determine the profitability of a group of demand accounts with the same owner. Account analysis is normally performed by the bank, but can be done by anyone in the depositor's organization provided sufficient information is available. Analysis identifies the net earnings based on the average daily ledger balance less reserved requirements and float. The net earnings can then be compared with the various activity service charges based on the volume of transactions and the per item price of the services. Accounts payable. A category of liabilities that represents funds due to creditors. Usually, accounts payable is due to trade creditors who have supplied goods or services without requiring immediate payment. Accounts payable are sometimes simply called payables. Accounts payable to trade creditors are sometimes called accounts payable trade, due to trade, or trade payables. Accounts receivable. An asset account that reflects amounts due from private persons or organizations for goods and services furnished. For corporations, accounts receivable excludes funds due from departments, but may include funds due from affiliates. For governments and nonprofit organizations using fund accounting, it does not include funds due from other funds owned by the same entity. A category of personal property defined by Article 9 of the UCC. Accounts receivable is the right to receive payment for goods sold or leased or for services rendered where those rights are not evidenced by an instrument or by chattel paper. Accounts receivable, trade also called trade receivables. Amounts due from the credit sales of goods or services that are not evidenced by promissory notes. Accreting swap, an interest rate swap with an increasing notional amount. Accretion, the process of making incremental, periodic increases in the book or carrying value of an asset. For example, when a bond is purchased at a price below 100, the difference between the purchase price and the par value, the discount, is accreted. Discounts are usually accreted in roughly equal amounts that completely eliminate the discount by the time that the bond has matured, or by the call date, if applicable. Accrual convention method used by investors for counting the number of days in each month and in the year. Also called accrual basis or day basis. The accrual convention is expressed in different ways. An accrual basis of 33/160ths indicates that every month is treated as if it was 30 days long and a year is assumed to have 360 days. Accrual basis of actual 360 indicates that each month is treated using its actual number of days while a year is assumed to have 360 days. Day basis of actual indicates that the true number of days for each month and year are used. The accrual convention is used in the calculation of the amount of interest payable on bonds, loans, deposits, and other financial instruments on the interest payment dates. This convention is also used for the purpose of calculating accrued interest due from a buyer to a seller of a security sold between interest payment dates. Accrued interest that has been earned but not yet paid. For example, the interest earned by a bondholder between semi-annual coupon payments or the interest earned by a lender since the last monthly interest payment was collected from the borrower. Accrued interest for investment securities is calculated from the issue date or the last payment date up to but not including the settlement date. When a buyer purchases a bond, the buyer owes the seller the accrued interest in addition to the market price of the security purchased. Accumulated Benefit Obligation, ABO. The actuarial present value of the pension benefits earned to date. Measurement of the accumulated benefit obligation uses the historical compensation rates for pay-related benefit plans. The ABO must be disclosed in a footnote to the financial statements. Accumulated depreciation, the total of the periodic reductions for depreciation in fixed assets. Also called allowance for depreciation. Adjustable rate mortgage, ARM, a loan for which the interest rate coupon rate is adjusted periodically to reflect changes in a previously selected index rate. ARMs may have caps and floors that limit the annual and/or the lifetime change in the coupon rate. Administered rates, interest rates that the bank or other payer is contractually permitted to change at any time and by any amount. For example, the rates paid on savings accounts. All interest rates can be categorized as either fixed, administered, or floating. Rates that may change at the payer's discretion are sometimes called variable rates, easily confused with floating rates, which change at contractually specified times by contractually specified amounts, a very different arrangement. Advanced Measurement Approaches, AMA, one of three methods for quantifying capital required for operational risk under proposed Basel II capital rules. Banks using the advanced measurement approaches must hold capital for operational risk based on a risk quantity generated by the bank's internal measurement procedures. The most common internal methods are self-assessments. See also self-assessment, standardized approach, basic indicator approach, and operations risk. Affiliate, a business organization that shares some aspect of common ownership or control with another business organization. Affirmative covenant, a provision in the lender's documents that requires the borrower to do something in the future. For example, a requirement for the borrower to provide annual audited financial statements to the bank during the term of the loan. Affordable growth rate, the maximum rate at which a firm's sales can grow without straining the capacity of the firm's capital or other financial resources. This term is closely associated with a formula of the same name. Paging, a report or schedule of all outstanding accounts payable or accounts receivable that lists all account debtors or creditors by name, shows the total amount due to each debtor, and shows how much of the amount due to each debtor is due within specific time periods. ALCO, see Asset Liability Management Committee. All an acronym for Allowance for Loan and Lease Losses. Allonge, paper attached to negotiable instruments for signatures when there isn't enough room on the instruments themselves for the signatures. Alt-AA, classification used to describe residential mortgage loans that are considered to be slightly less risky than subprime loans. The loan structure and/or the borrower's credit score are typically better than the very worst loans but are still high risk. Common in parts of the USA during the 2000-2007 boom. Now amortization. 1. The process of making regular, periodic decreases in the book or carrying value of an asset. For example, when a bond is purchased at a price above 100, the difference between the purchase price and the par value, the premium, is amortized. Premiums are usually amortized in roughly equal amounts that completely eliminate the premium by the time that the bond has matured or by the call date, if applicable. 2. Liquidation of a loan or security by means of periodic reductions. The principal amount of loans is amortized by the periodic, usually monthly, payment of a fraction of the principal calculated to repay the entire amount of principal due by the date of the last scheduled periodic payment. Amortization methods differ based upon the type of loan. Mortgage loans and securities usually have level payments of principal and interest. For such amortizations, the interest consumes most of the early payments and, therefore, principal amortization increases as the loan ages. Many business loans use a level amortization with roughly equal principal reductions from each periodic payment. Amortization period for financial instruments, the time from the inception of a loan or investment instrument with scheduled principal repayments to the due date of the final contractually obligated principal repayment. For fixed assets, the period from the acquisition of a fixed asset to the date of the last periodic reduction, made to reflect depreciation, of the book value of that asset. Assets may be depreciated until the book value is zero, but sometimes are only depreciated until the book value is reduced to an assumed salvage value. Amortizing swap, an interest rate swap with a declining notional principal. Annual percentage rate, APR. The total financing costs associated with a loan on an annualized basis, divided by the amount borrowed. As defined by Federal Reserve Regulation Z and the Truth in Lending Act, this is a precisely calculated measure of the cost of a loan. The Truth in Lending Act and Regulation Z have specific requirements covering both how to calculate and how to disclose APRs. Annual percentage yield, APY, a precisely calculated measure of yield paid on a bank deposit account. Appraisal, a statement or estimate of the market value of tangible personal property or real estate. Under the Federal Appraisal Regulations for real estate pledged to secure loans, the term appraisal refers to a statement of market value that meets the 5 specific standards. See complete appraisal, evaluation, and limited appraisal. Appraisal surplus, the difference between the historical cost and the appraised value of any fixed assets. Arbitrage. Arbitrage is the simultaneous purchase and sale of two identical commodities or instruments to take advantage of price variations in different markets. For example, the purchase of gold in London and the simultaneous sale of gold in New York. Arbitrage for us private bankers is simply the spread between the amount we borrow and the amount we receive. Arbitrage CDO, a CDO whose purpose is to allow a money manager to expand assets under management and equity investors to achieve non-recourse leverage to CDO assets. There is no arbitrage in the classic sense of the word. Rather, equity holders hope to capture the difference between the after-default yield on the assets and the financing cost due debt tranches. Arbitrager, an individual or broker who engages in arbitrage. Asset-backed security, ABS, a debt security collateralized by assets. Created from the securitization of any loans. 1. The phrase may describe the broad category that includes named subcategories such as securitized residential mortgage loans, RMBS, and securitized commercial mortgage loans, CMBS. 2. The phrase directly names asset-backed securities created from consumer installment or credit card loans. 3. Securitized commercial. Non-consumer obligations not secured by real estate are typically called collateralized debt obligations or CDOs. CDOs are sometimes defined to be a subset of ABSs. ABSs may be structured in a variety of ways including simple, pass-through, structures and complex, multi-tranche, structures. The value that ABSs provide to investors is the cash flows due to the ABS holders from the underlying loans. ABS issues are typically structured so that the bankruptcy or insolvency of an underlying borrower does not impact the cash flow received by the security owner. See Special Purpose Vehicles and Waterfalls. Asset sensitive describes an entity's position when an increase in interest rates will help the entity and a decrease in interest rates will hurt the entity. An entity is asset sensitive when the impact of the change in its assets is larger than the impact of the change in its liabilities after a change in prevailing interest rates. This occurs when either the timing or the amount of the rate changes for liabilities causes interest expense to change by more than the change in interest income. The impact of a change in prevailing interest rates may be measured in terms of the change in the value of assets and liabilities. In that case, an asset-sensitive entity's economic value of equity increases when prevailing rates rise or declines when prevailing rates fall. Alternatively, the impact of a change in prevailing rates may be measured in terms of the change in the interest income and expense for assets and liabilities. In that case, an asset-sensitive entity's earnings or net income increases when prevailing rates rise and declines when prevailing rates fall. Asset liability management coordinated management of all of the financial risks inherent in the business conducted by a financial institution. The process of balancing the management of separate types of financial risk to achieve desired objectives while operating within predetermined, prudent risk limits. Accomplishing the task requires coordinated management of assets, liabilities, capital, and off-balance sheet positions. Therefore, in the broadest sense of the term, is simply the harmonious management of cash, loans, investments, fixed assets, deposits, short-term borrowings, long-term borrowings, capital, and off-balance sheet commitments. However, in practice, the term is often used to refer to segments of that broader definition such as only interest rate risk management or only interest rate and liquidity risk management. See earnings at risk, market value at risk and market value of portfolio equity. Assets repriced before liabilities, a measure of the gap between the quantity of assets repricing and the quantity of liabilities repricing within a given period of time. A simple measure of a financial institution's exposure to beneficial or adverse consequences from changes in prevailing interest rates. Assignment transfer of any contractual agreement between two parties. One of the parties, the assignor, transfers its rights or obligations to another party, the assignee. If interests in assets of the assignor are assigned, the assignment transfers all or some of the rights of ownership to the assignee. If interests in obligations of the assignor are assigned, the assignor is totally or partially absolved from further performance. Lenders sometimes see leased property assigned from the original lessor to another party who then pledges them to the bank as collateral for a loan. For personal property collateral, a secured party may enter an assignment of its security interest into the public record by using a standard form called UCC3. Assignment of buyer's interest in land contract, a document used when a borrower is purchasing real estate over time under an article of agreement or land contract. The document assigns the lender all of the borrower's personal property, real property, and contractual rights under the land contract. Assignment of lease and rentals, a document used in real estate loans when the mortgaged property is leased to third-party tenants. If the borrower defaults, the assignment of lease and rentals gives the lender the right to receive rents from the tenants and to transfer the leases to a subsequent purchaser of the property. Assignment of seller's interest in land contract, a document used in real estate loans when the mortgaged property is subject to a land contract or article of agreement under which it is being sold over time to a third party. If the borrower defaults, the assignment of the land contract gives the lender the right to receive payments from the buyer and to transfer the land contract to another buyer. Association of Financial Professionals, a national organization for finance professionals that provides educational and certifications programs, research programs, standards development, and government relations activities. Assumable is applied to mortgage loans. Assumable means that a borrower who sells his or her home may transfer the outstanding mortgage loan secured by that dwelling to the new buyers. The new buyers are said to assume the loan. Assumed name used by a proprietorship, partnership, or corporation to conduct business that is different from the legal name of the proprietorship, partnership, or corporation. Sometimes an assumed name is prefaced by the initials TA for trading as, or DB for doing business as. Asymmetric behavior, unbalanced behavior exhibited by financial instruments, the rates are values of which do not change in proportion to changes in market rates. For example, increases in the prime rate quickly reflect most or all of the increases in prevailing interest rates, while decreases in the prime rate are slow to reflect decreases in prevailing interest rates. Attrition analysis evaluation of the reduction in the amount of an asset or liability held. For example, an analysis of the reduction in savings account as caused by withdrawals over time. Audited statements, the most reliable type of financial statements. The audit is based on information submitted by the client, and the CPA does not verify all of the information. Limits on the scope of the audit and on the CPA's responsibility are described in the opinion letter that accompanies the audited statements. However, the value of an audited statement is that the independent CPA is responsible for testing and verifying any numbers that seem questionable or unusual, as well as the most material financial information. For example, if a firm has a material amount of accounts receivable, the auditor will typically confirm at least a sample of those accounts. If a firm has a material amount of inventory, the auditor will typically perform a physical verification of that inventory. Availability, the condition in which deposited funds are available for use by the depositor. The time lag between the date of a deposit and the date it is credited to the collected balance. Available balance, the balance in an account that can be invested or withdrawn. Available balance refers to the bank ledger balances less checks in the process of collection. Also called collected balances, good funds, or usable funds. Average daily balance, the average daily balance is a method used to calculate finance charges. It is calculated by adding the outstanding balance on each day in the billing period, and dividing the total by the number of days in the billing period. The calculation includes new purchases and payment. 5. Promissory notes. A promissory note, sometimes referred to as a note, is a legal instrument, more particularly, a financial instrument and a debt instrument, in which one party, the maker or issuer, promises in writing to pay a determinate sum of money to the other, the payee, either at a fixed or determinable future time or on demand of the payee, under specific terms. International law. In 1930, under the League of Nations, a convention providing a uniform law for bills of exchange and promissory notes was drafted and ratified by 18 nations. Article 75 of the treaty stated that a promissory note shall contain the term promissory note inserted in the body of the instrument and expressed in the language employed in drawing up the instrument, an unconditional promise to pay a determinate sum of money, a statement of the time of payment, a statement of the place where payment is to be made, the name of the person to whom or to whose order payment is to be made, a statement of the date and of the place where the promissory note is issued, the signature of the person who issues the instrument maker. Promissory note defined. 1. A promissory note is an unconditional promise in writing made by one person to another, signed by the maker, engaging to pay, on demand or at a fixed or determinable future time, a sum certain in money, 2, or to the order of, a specified person or to bearer. 2. An instrument in the form of a note payable to the maker's order is not a note within the meaning of this section unless and until it is endorsed by the maker. 3. A note is not invalid by reason only that it contains also a pledge of collateral security with authority to sell or dispose thereof. 4. A note which is, or on the face of it purports to be, both made and payable within the British Islands is an inland note. Any other note is a foreign note. A brief history. In China during the Han Dynasty, rye notes appeared in 118 BC and were made of leather. The Romans may have used promissory notes in 57 AD as a durable lightweight substance, as evidence of a promise in that time have been found in London. Historically, promissory notes have acted as a form of privately issued currency. Flying cash or fakion was a promissory note used during the Tang Dynasty, 618 to 907. Flying cash was regularly used by Chinese tea merchants, and could be exchanged for hard currency at provincial capitals. The Chinese concept of promissory notes was introduced by Marco Polo to Europe. There is evidence of promissory notes being issued in 1384 between Genoa and Barcelona, although the letters themselves are lost. The same happens for the ones issued in Valencia in 1371 by Bernat de Codenix for Manuel d'Antenca, a merchant from Huesca, then part of the Crown of Aragon, amounting a total of 100 florins. In all these cases, the promissory notes were used as a rudimentary system of paper money, for the amounts issued could not be easily transported in metal coins between the cities involved. Ginaldo Giovanni Battista Strozzi issued an early form of promissory note in Medina del Campo, Spain, against the city of Besançon in 1553. However, there exists notice of promissory notes being in use in Mediterranean commerce well before that date. Now Lesson 6. Deed of Trust. A deed of trust or trust deed is a legal instrument which is used to create a security interest in real property wherein legal title in real property is transferred to a trustee, which holds it as security for a loan debt between a borrower and lender. The equitable title remains with the borrower. The borrower is referred to as the trustor, while the lender is referred to as the beneficiary. Historically, some of these documents were titled deeds of trust, and others were titled trust deeds, and U.S. case law prior to about 1990 tends to reflect both usages. Due to the rise of real estate securitization in the 1990s and the shift from lend to hold to lend to securitize, the majority of residential real estate transactions are now completed with uniform security instruments which are consistently described as deeds of trust, so as to avoid confusion with true trusts or true deeds. Thus, the more precise term of art, deed of trust, has become predominant in the case law since then. Though a mortgage is technically an entirely different legal instrument, as noted above, deeds of trust are frequently called mortgages in the real estate loan business due to the functional similarity between deeds of trust and mortgages. Although a deed of trust usually states that the borrower is making an irrevocable transfer to the trustee, it is common in many jurisdictions for borrowers to obtain second and third mortgages or trust deeds that make similar transfers to additional trustees. That is, of a property they already conveyed to the trustee on their first deed of trust. As with mortgages, deeds of trust are subject to the rule, first in time, first in right, meaning that the beneficiary of the first recorded deed of trust may foreclose and wipe out all junior deeds of trust recorded later in time. If this happens, the junior debt still exists, but may become unsecured. If the debtor has sufficient your secured claims upon his assets, lacks equity, or is otherwise insolvent, the junior liens may be wiped out completely in bankruptcy. Lesson 7. Collateral security instrument. Collateral security instrument means any right, document or instrument, other than the mortgage, given as security for the loan, including, without limitation, the assignment of rents and leases, the collateral assignment of hedge, the note pledge agreement and the contract assignment. Corporate Finance Institute. Collateral: an asset or property that an individual or business offers to a lender to obtain a loan. What is collateral? Collateral is an asset or property that an individual or entity offers to a lender as security for a loan. It is used as a way to obtain a loan, acting as a protection against potential loss for the lender should the borrower default in his payments. In such an event, the collateral becomes the property of the lender to compensate for the unreturned borrowed money. Collateral: for example, if a person wants to take out a loan from your bank, he may use his car or the title of a piece of property as collateral. If he fails to repay the loan, the collateral may be seized by the bank, based on the two parties' agreement. If the borrower has finished paying back his loan, then the collateral is returned to his possession. Types of collateral. In order to be able to take out a loan successfully, every business owner or individual should know the different types of collateral that can be used when borrowing. 1. Real estate. The most common type of collateral used by borrowers is real estate, such as one's home or a parcel of land. Such properties come with a high value and low depreciation. However, it can also be risky because if the property is sequestered due to a default, it cannot any longer be taken back. 2. Cash secured loan. Cash is another common type of collateral because it works very simply. An individual can take a loan from the bank where he maintains active accounts, and in the event of a default, the bank can liquidate his accounts in order to recoup the borrowed money. 3. Inventory financing. This involves inventory that serves as the collateral for a loan. Should a default happen, the items listed in the inventory can be sold by the lender to recoup its loss. 4. Invoice collateral. Invoices are one of the types of collateral used by small businesses, wherein invoices to customers of the business that are still outstanding, unpaid, are used as collateral. 5. Blanket liens. This involves the use of a lien, which is a legal claim allowing a lender to dispose of the assets of a business that is in default on a loan. Borrowing without collateral. Not all loans require collateral, especially if the borrower doesn't have any property to offer. In such a case, there are several ways to borrow money, including 1. Unsecured loans. From the name itself, unsecured loans don't give the lender any form of assurance or protection that the money will be returned. However, they usually involve relatively smaller amounts than what might be loaned against collateral. Examples of unsecured loans include credit card debts. 2. Online loans. With the advancement of technology, there are many more ways to get a loan. In fact, people can now obtain online loans that don't require collateral and are often approved quickly. After filling out an application form, the lender will let the applicant know if he or she is approved, how much the loan amount is, the interest rate, and how the payments are supposed to be made. 3. Using a co-maker or co-signer. These types of loans don't require property for collateral. Instead, another individual besides the borrower co-signs the loan. If the borrower defaults, the co-signer is obliged to pay the loan. Lenders prefer co-signers with a higher credit rating than the borrower. A co-signed loan is often one way an individual without established credit can begin to establish a credit history. Collateral versus security. Collateral and security are two terms that often use people who think the terms are completely synonymous. In fact, the two concepts are different. The differences are explained below. Collateral is any property or asset that is given by a borrower to a lender in order to secure a loan. It serves as an assurance that the lender will not suffer a significant loss. Securities, on the other hand, refer specifically to financial assets, such as stock shares, that are used as collateral. Using securities when taking out a loan is called securities-based lending. Collateral can be the title of a parcel of land, a car, or a house and lot, while securities are things such as bonds, futures, swaps, options, and stocks. Collateral, or at least the ownership title to it, stays with the lender throughout the time the borrower is paying the loan. Securities, on the other hand, allow the borrower to benefit from both the loan and the securities portfolio even while the loan is still being paid back because the securities portfolio remains under the borrower's control. However, the lender assumes a greater risk because the value of the securities may fluctuate substantially. Lesson 8. Real estate investing. Real estate investing involves the purchase, ownership, management, rental and/or sale of real estate for profit. Improvement of realty property as part of a real estate investment strategy is generally considered to be a subspecialty of real estate investing called real estate development. Real estate is an asset form with limited liquidity relative to other investments. It is also capital intensive, although capital may be gained through mortgage leverage, and is highly cash flow dependent. If these factors are not well understood and managed by the investor, real estate becomes a risky investment. Net operating income, or NOI, is the sum of all positive cash flows from rents and other sources of ordinary income generated by a property, minus the sum of ongoing expenses, such as maintenance, utilities, fees, taxes, and other items of that nature. Debt service is not factored into the NOI. The ratio of NOI to the asset purchase price, expressed as a percentage, is called the capitalization rate, or cap rate, and is a common measure of the performance of an investment property. Tax shelter offsets occur in one of three ways: depreciation, which may sometimes be accelerated tax credits, and carryover losses, which reduce tax liability charged against income from other sources. 7.5 years. Some tax shelter benefits can be transferable, depending on the laws governing tax liability in the jurisdiction where the property is located. These can be sold to others for a cash return or other benefits. Equity buildup is the increase in the investor's equity ratio as the portion of debt service payments devoted to principal accrue over time. Equity buildup counts as positive cash flow from the asset where the debt service payment is made out of income from the property, rather than from independent income sources. Capital appreciation is the increase in the market value of the asset over time, realized as a cash flow when the property is sold. Capital appreciation can be very unpredictable unless it is part of a development and improvement strategy. The purchase of a property for which the majority of the projected cash flows are expected from capital appreciation, prices going up rather than other sources, is considered speculation rather than investment. Management and evaluation of risk is a major part of any successful real estate investment strategy. Risks occur in many different ways at every stage of the investment process. Below is a tabulation of some common risks and typical risk mitigation strategies used by real estate investors. Common risks and mitigation strategies with real estate investing. Risk mitigation strategy: fraudulent sale, verify ownership, purchase title insurance, adverse possession, obtain a boundary survey from a licensed surveyor, environmental contamination, obtain environmental survey, test for contaminants, lead paint, asbestos, soil contaminants, etc. Building component or system failure. Complete full inspection prior to purchase, perform regular maintenance. Overpayment at purchase. Obtain third-party appraisals and perform discounted cash flow analysis as part of the investment pro forma. Do not rely on capital appreciation as the primary source of gain for the investment. Cash shortfall. Maintain sufficient liquid or cash reserves to cover costs and debt service for a period of time. Economic downturn. Purchase properties with distinctive features in desirable locations to stand out from the competition. Control cost structure. Have tenants sign long-term leases. Tenant destruction of property. Screen potential tenants carefully. Hire experienced property managers. Underestimation of risk. Carefully analyze financial performance using conservative assumptions. Ensure that the property can generate enough cash flow to support itself. Market decline. Purchase properties head on. A conservative approach that the market might decline and rental income may also decrease. General wear and tear. Undertake DIY or professional technicians such as plumbers, electricians, builders, carpenters. Fire, flood, personal injury insurance policy on the property. Tax planning. Plan purchases and sales around an exit strategy to save taxes. Lesson 9. Lending against real estate. Hard money loans and hard money lenders. Hard money loans are backed by hard or tangible assets like real estate. Hard money is used to finance properties for very brief periods, a few months to a few years, at interest rates that are higher than conventional property loans. Hard money can be used to renovate and flip a house, for example, or to buy a rental property until a mortgage can be put in place. A hard money lender will typically lend up to 65–70% of a property's after repaired value, ARV, which is the amount it is expected to sell for after it has been renovated. Hard money lenders usually charge at least 10–15% interest, plus points, which are a percentage of the total loan. Hard money lenders are also in the first lien position, meaning that if the borrower runs into financial trouble, they are the first creditors in line to be paid if the borrower has to sell those tangible assets. Hard money loans can be structured in various ways. The borrower may not have to pay any interest or points until they sell a renovated house, for example, at which point they make one large payment to the lender for the loan principal, interest and points. Please note that all the numbers and values used here are strictly hypothetical and for illustrative purposes only. Here's how real estate financing works. Jason puts in a bid on a foreclosed house for $50,000 that he plans to renovate and flip for an ARV of $120,000. You receive an email with Jason's information and you compare it with your underwriting criteria. You decide to do the loan at 12%, lending $84,000. The hard money lender lends Jason $84,000, 70% of the property's estimated ARV, at 14% interest and 3 points for 6 months. Jason will use the funds to buy and renovate the house. Jason conducts the repairs and renovations on the house. The lender pays the repair and renovation bills directly from the loan as they are. Son sells the house for $120,000. Jason pays the hard money lender $11,760 in interest, plus $2,520 in points, 3% of the $84,000 loan, as well as the loan principal of $84,000. You receive $84,000 plus $10,080 for a total amount of $94,080. Not bad. Jason's profit after paying back the hard money lender is $21,720. Scenario A. Amber buys the bakery with $600,000 debt at 8% from her parents plus $400,000 equity. Bakery revenue $200,000, interest expense minus $48,000, pre-tax income $152,000, after tax income at 35%, tax rate $98,800, annual return on Amber's $400,000, equity investment 24.7%. Scenario B. Amber buys the bakery with $600,000 debt at 8% from her parents plus $200,000 equity plus $200,000 mezzanine loan at 15%. Bakery revenue $200,000, interest expense minus $78,000, pre-tax income $122,000, after tax income at 35%, tax rate $79,300, annual return on Amber's $200,000, equity investment 39.7%. By using a mezzanine loan, Amber's after-tax profits fall from $98,800 to $79,300. But because she cut her equity investment in half from $400,000 to $200,000, her return on her equity rises from 24.7% to 39.7% per year. Not too shabby. Lesson 10 BOLI's Bank-Owned Life Insurance. Bank-owned life insurance BOLI is a form of life insurance purchased by banks where the bank is the beneficiary and also usually the owner of the policy. Such insurance is used as a tax shelter for the financial institutions, which leverage its tax-free savings provisions as funding mechanisms for employee benefits. How bank-owned life insurance BOLI works. BOLI contracts are primarily used by banks to fund employee benefits at a much lower rate than they might have to pay otherwise. The process works like this: the bank sets up the contract, and then makes payments into a specialized fund set aside as the insurance trust. Key takeaways: bank-owned life insurance BOLI is a form of life insurance used in the banking industry. This type of insurance is used as a tax shelter by banks and funds employee benefits. A significant concern for banks is the credit quality of the BOLI issuer. BOLICOLI.com is a firm whose role is helping manage corporate-owned and bank-owned life insurance portfolios. All employee benefits that need to be paid to particular employees covered under the plan are paid out from this fund. All premiums paid into the fund, in addition to all capital appreciation, are tax-free for the bank. Therefore, banks can use the BOLI system to fund employee benefits on a tax-free basis. Bank-owned life insurance is a kind of tax shelter providing funds tax-free to the bank to offset costs. As the U.S. Department of the Treasury's Office of the Comptroller of the Currency (OCC) explains, banks are allowed to purchase BOLI policies in connection with employee compensation and benefit plans, key person insurance, insurance to recover the cost of providing pre- and post-retirement employee benefits, insurance on borrowers, and insurance taken as security for loans. OCC may also allow for other uses on a case-by-case basis. Pros and cons of bank-owned life. Is BOLICOLI.com, a firm that helps manage corporate-owned and bank-owned life insurance portfolios, notes, BOLI was traditionally combined with benefit plans for new senior executives. But more recently, many banks have added BOLI in order to offset existing employee benefit expenses. As noted, the advantages of BOLI included its tax favorability and the ability to generate earnings that offset the costs associated with employee benefits programs. But BOLICOLI.com notes that there are disadvantages too. For instance, if a BOLI contract is surrendered by the bank, the gains within the policy become taxable, as well as a 10% IRS penalty on the gain, similar to surrendering an IRA prior to age 59.5. If the policy is held to the death of each insured, the gain becomes part of the tax-free death benefit and no tax is incurred. Additionally, the greatest concern for most banks is the credit quality of the BOLI carrier. Most carriers in the market are of the highest quality, however, that can change over time. The second concern is the competitiveness of the crediting rate in comparison to the market. 11 Lending money to other people. Velocity V_T equals frac PTM. V_T equals velocity of money for all transactions in a given time frame. P equals price level. T equals aggregate real value of transactions in a given time frame. M equals total nominal amount of money in circulation on average in the economy. The velocity of money can be calculated as the ratio of nominal gross domestic product (GDP) to the money supply. V equals PQM, which can be used to gauge the economy's strength or people's willingness to spend money. The velocity of money can be calculated as the ratio of nominal gross domestic product (GDP) to the money supply. V equals PQM, which can be used to gauge the economy's strength or people's willingness to spend money. To become a private lender and loan out money to other people, there are two different phases you need to set up. Phase 1, the one-time setup of the banking entity. And then in Phase 2, the ongoing activities. In Phase 1, you will set up your banking business, an LLC, a business name, and so on. You need to understand lending, including the laws and regulation in your state or province. You need to build your underwriting criteria, your policies. You need to build a team. And you may need to get some training. This book does not go into the exact training. Hopefully this will motivate those that are willing to do the work. In Phase 2, you can start lending yours and others' money. You'll need to find the borrowers and you'll need to find sources of other people's money. OPM. Now to get started, you need to know that lending is different in every state. Now don't worry, there are people who specialize in dealing with all these regulations. There are licensed mortgage brokers that know the laws and regulations. You will be dealing directly through them. All you need is cash flow. The mortgage brokers know the industry and how to lend the money. It is good for you to understand this as well. This way, know your business and how your money is being lent. Remember, the brokers are licensed, and we are not. They make money by charging borrowers points. We make our money on spreads. What's why it's important to build your underwriting criteria. Underwriting criteria standards that you create that your borrowers must meet and follow. This should minimize your risks. The perimeters are set by the lender, you, and help filter who you allow to borrow. Your policies document the rules you set for yourself and other borrowers. You may also want to use a risk management document. Part of your team, including you, a mortgage broker, private money lender or money broker, your bookkeeper, and a good accountant. This is vital to running a successful and legal lending institution. Now for phase 2, you can now begin lending. All the recommendations that you present as a private lender. You need to first of all, find borrowers. Finding these borrowers may be a lot easier than you believe. You can even make it automatic if you trust your broker or money lender to get you the deals. They can even be emailed to you, and you can get back to them in your spare time. The business will seem relatively easy and simple once you've done it a few times. If you do it automatically, the broker will send you loans and you can compare it with your underwriting criteria. And if it's suitable, you then can loan the money through a wire or however you have it set up. The best part is that the borrower pays for all of this. The team that you build are all paid by the borrowers. A win-win for all. Lesson 12: Lending Laws and Practices. I cannot give you legal advice on this subject, but I can share some information to give you an idea. I encourage you to research the laws in your area. Some examples: the Federal Fair Lending Laws, the Equal Credit Opportunity Act, and the Fair Housing Act prohibit discrimination in credit transactions, including transactions related to residential real estate. The ECOA prohibits discrimination in any aspect of a credit transaction. The ECOA is not limited to consumer loans. It applies to any extension of credit, including extensions of credit to small businesses, corporations, partnerships, and trusts. The Truth in Lending Act (TILA) protects you against inaccurate and unfair credit billing and credit card practices. It requires lenders to provide you with loan cost information so that you can comparison shop for certain types of loans. An example of the Truth in Lending Act's protection is its requirement that information concerning the following items be communicated to borrowers before they should be expected to accept the terms of a loan or line of credit: annual percentage rate (APR), term or length of the loan. How do banks decide to give loans? When you apply for a loan, you authorize the lender to run your credit history. The lender wants to evaluate two things: your history of repayment with others and the amount of debt you currently carry. The lender reviews your income and calculates your debt service coverage ratio. Lesson 13: Mastermind. A mastermind group is a peer-to-peer mentoring group used to help members solve their problems with input and advice from the other group members. The intention of a mastermind group is that peers can help each other solve problems and develop themselves together through input and advice from each other. The core value of a mastermind group is the synergy of energy, motivation, and commitment, as well as the willingness to learn and grow together. Most groups meet either on a weekly, bi-monthly, or monthly basis, but there is no hard and fast rule. I recommend you meet at least once a month, though. You want to be able to help keep the group focused and accountable, and it's hard to do that if you only see each other every 2 to 3 months. Mastermind groups are give and take. Choose group members that are willing to do both and are fully committed to the group. They should make a commitment to be at every meeting, be open to advice, give advice and support, and be respectful of others and of the group rules. In my mastermind groups, I tend to look for 4 to 8 members per group. Less than 4 and the energy level can drop, though I know several very successful mastermind groups with 3 members in them, and more than 8 members will probably cause you to run out of time. Although there are a number of interpretations of what a mastermind alliance group is, generally speaking it is a group of like-minded individuals gathering together, in person or on the phone, in the interest of accomplishing individual or collective transformational and extraordinary results. Summary: in summary, building your bank, it's not only easy. It is necessary to build massive wealth. Keep in mind that you need to keep the mindset of the banker. Otherwise you may lose all you built. Knowing these rules, you can build fabulous wealth and keep it too. Remember to follow the rules. Stick to your underwriting criteria. Stay the course, don't break the rules. And watch your wealth grow.
Thanks for listening. Like and subscribe.